that quite a lot of positions would have been built into these stocks going into today's trading session.
All right, Vivek, thank you very much for that. So we just, I think running into market open is 340 points. So 24,253 is where the Nifty is seemingly opening up at. So still about 100 points away from, the 24,340-ish kind of zone, which is where the first, to my mind, the big resistance, not the big, but the first kind of resistance comes in, which is the 40-day. That is exactly at about 24,340. And in the morning, it was looking like you'll open right into that. So maybe this is not such a bad thing. You're not, not the entire, or not all of the juice is out right in the, right at the first stick. So maybe, something to do for the rest of the day as far as the Nifty goes. Let's see. Indices first, and then we'll get into individual stocks, etc. There you go, 24,240 is about 1.33% higher. You've got the Nifty Bank, which is up about 1.3%, 51,826. The mid-cap index is up about 1.7%. And this is the overall market start. Look at that, 49 out of the 50 stocks on the Nifty heat map are starting in the green. Just one name, that is JSW Steel, which of course is out of the Sensex, and Zomato is in the Sensex, but the impact is showing up there on JSW Steel, which is slightly lower. Otherwise, it's a very, very good start. 385 points, 390 points, and this is just the first 1 minute of market open that we are looking at. So lots to talk about. IT index, we're just having that discussion with Apurva. The IT index is up another 0.9% this morning.
PSUs, it is the return of the PSUs. That's the point that we were making earlier as well, that will the market start looking at some of the CapEx/PSU themes again. That seems to be happening sentimentally, at least right now. So before I talk about the Nifty, look at RVNL, Aircon, Railtel, Hoodco, PFC, NBCC, REC, IRFC, and the whole pack where the volumes are piling in, and these are gains in excess of 3, 4, 5%. In some cases like RVNL, 7-8%. Aircon is up 6%. So massive move in PSUs at the start. Now on the large cap screen, everything is up apart from JSW Steel. Every other single Nifty stock is on the green side of the screen. What a big move this is turning out to be. So let's talk about the best winners or the biggest movers. Shriram Finance 6% up, M&M 4%, BEL 4%, Adani Enterprises 3.5%. There is L&T, BPCL, ONGC, NTPC. Doesn't matter. Take anything, throw a dart at the board, and you'll land up on the green side. It's that kind of a day. The big heavyweights are obviously contributing. SBI, Reliance, 2 to 3% up on these stocks. HDFC Bank, 2% up. ICICI Bank, all of them are up and about. And obviously, it's a very risk-on sort of a market. So relatively speaking, lesser appetite for pharma and FMCG. Cipla, Apollo Hospitals, Dr. Reddy's. These are stocks which are not getting that much. I mean, this is not their day. It's all about risk-on, big stocks, economy-facing stocks, and PSUs. That's how it seems to be playing out. The Nifty is holding on to this 350-point gain. Bigger stories in the mid-cap index. That one's surging almost 1,000 points now.
Well, that's right. Just take a look at a few more stocks. IFCI, that one's flying away. One of the top volume movers. I think it's up close to 9%. You have Easy Trip as well. The stock has been a big underperformer, corrected big time from the top. It had a bit of a bounce in Friday's trading session. It's bounced again today. It's up close to around 6% or thereabouts. Jyoti Structures, they're looking to raise some money. The stock had corrected from around 40 rupees to around 30 rupees. I think that as well is one of the top volume movers, up close to around 4%. This infra push, there is some kind of a fear when there is a state election that some of those projects could run into some trouble. If there was that kind of a doubt, now that's out of the window. So you have HCC, J. Kumar, that is flying away. Both of them doing very, very well in today's trading session on decent volumes. Lloyds Metals, it's a mining major here in Maharashtra. So that as well is up close to around 5%. As is, the stock has moved, I think, from around 200 rupees 3-4 years ago, all the way to around 1,000 rupees. It corrected a little bit from the top, but Lloyds Metals as well is up, one of the top movers in today's trading session. Add to the list, you have Swan Energy. That one as well is higher in today's trading session. So let's pull that up. And Crystal as well, one of the recent listings. Well, that stock as well is moving very, very well in today's trading session. So we're holding on to solid gains. What's not doing too well? Very few stocks. I think Symphony's come in for some profit taking. It's down close to around 3%. Vare Energy is, it's corrected considerably from the recent peak. It went to around 3,700 rupees. Now it's up 2,700 rupees. So there has been some selling on that one as well. Need to keep an eye on a couple of these stocks. And I think that's about it. DOMS is a little bit low, but volume's very, very thin out there. So a rocking start. The Nifty well above that 20 DMA. The Nifty Bank has taken out the 20, the 50 DMA as well. It's moved to around 52,000 odd, and that's leading the charge this morning. Prashant, a very, very good-looking screen. You have 10 stocks advancing for one stock that's declining. Bazooka times.
And the point is, Nigel, anything incrementally fresh you're able to do in terms of make money is great. But the point is, nobody starts from scratch.
Yeah.
People have holdings, portfolios, and those portfolios can breathe with an open like this, right?
Indeed.
Which I think is a great thing. So while we are focused on the next big thing, existing portfolios were also under pressure, and this provides reprieve. So keep that in mind as well. So you've got Zomato, by the way, which is the #1 volume-led gainer with a 5.5% gain. PFC and REC, I think we mentioned 5% a pop each. RVNL is up 9%. Swan Energy is up 4%. Adani Energy Solutions. Actually, we should just look at all the Adani Group stocks very quickly and see if there is some relief coming in that part of the market as well. Okay, so here we go. Enterprises is up 3%. Green is up 4%. That is Adani Green. There is Energy Solutions, which is up 6.5%. Ports is up almost 3%. Ports Thursday low was 995. Stocks back at about 1170. And you've got Adani Power, which is up about 2%, 2.25% as well. So that is the Adani Group pack, which is also seeing some relief come through. So all these, I mentioned RVNL, but look at IRFC, RITES. These are all railway, IRCON. These are all these railway companies which are seeing 5, 6, 7% kind of lifts this morning. Raymond on Friday ended 20% higher. It's up another 6%. So very strong move coming in from Raymond. The low recently on Raymond was about $1,300. Stocks at about $1,750 now in 4-5 trading sessions. So that's the bulk of what is coming through. So I was talking about railway, but mostly PSUs. But look at Titagarh. I'm not sure if you're missing any news flow, but 6% on Titagarh coming through right now. We'll sort of look at more as we go along. On the downside, apart from I think what we already mentioned, not very much. It's all very quiet and volumes are lacking. It's all sort of kind of one way with 2,100 stocks up and about 190, 200 stocks which are lower. 10:1 in terms of advances to decline ratio. Manish Santalia is with us, Chief Investment Officer at NK Investment Managers. Manish, good to have you with us here. Thank you for your time. Fag end of the year, and I think we are just about getting into that period where we start to talk about what 25 will look like. But before we get there, just your sense, does it look like, is it beginning to look like that we are putting this corrective phase behind us? The first 10% plus kind of fall for the indices over the last 3-4 years. Do you think we are starting to put that behind us now?
So, Prashant, of course, we have seen a 10% correction on the back of massive liquidation by FIIs. Now, the crux to whether the markets would have seen the bottom or not would really depend on how earnings shape up. You know that earnings have been very anemic, single-digit sort of earnings growth for FY25. And because of very slow government spending, you are also looking at a very muted earnings growth for FY26. At best, as things stand today, and things could change very fast because, there could be a lot of government spending which could be due in second half of fiscal 25, or there could be some measures to revive demand in the system. Consumption is really falling off the cliff. But as things stand today, we are looking at a 10 to 12% sort of a growth in Nifty 50 earnings for FY26. And if you would like to extrapolate that sort of a growth for even FY27, you're looking at another 10 to 12%. So average of FY26 and 27 comes to around 1,250 or 1,245. Now, for a 10 to 12% earnings growth, the moot point is whether you would be willing to assign a 20p multiple, which the markets have given over the last 3 to 5 years. Whereas the 12-year long period average of Nifty 50 has been 80. So if you would want to see the maximum margin of safety, I can believe that the markets can test. I'm not saying it will test. It will depend on a lot of things as to how earnings shape up and how expenditure happens and how demand revives on the consumption side. But it can come down to 22,000, 22,500. Markets don't fall in a straight line. And whether the FIs would have seen the worst of selling or there could be more. Because emerging markets as a whole are selling. So it's not only particular to India. These things would be there. And I think it's a pullback. But it's good to see green on the screen after a long time. But one would really keep fingers crossed to see if the market sustains that current.
Okay, so that takes a big, bold person to give out a clear call. I mean, even if it's bearish on a morning like this. Manish, great to have you on. I just heard you say that 22,000 is still on the table, yeah?
Now, fundamentally speaking, should be 1175 on a 1050 base for FY25. That is a 12% growth. And if you were to extrapolate another 12% on 1175, that gives you 1315. So 1 year out, an average of 1175 and 1315 is 1245. Now, the moot point is for a 12% earnings growth on Nifty 50, would the market be willing to give a 20p? Whereas the long period average of 10 to 12 years is 18 times. So the maximum margin of safety would happen if you were to extrapolate 1245 and multiply it by 18 times. That would be broadly 22 and a half.
You know, Manish, the numbers are perfect. We completely get the logic going by numbers. But the thing is, it's the direction of money which starts becoming illogical at times, right? And it's the FPI exodus, which is why we got the correction. And who knows what they're going to do tomorrow. If they start returning, then what multiples do we trade at? That's a different debate. Right now, I want to focus on what we're seeing at present, which is, an interest coming back in the PSU side of the market. Obviously coming in, emanating from what we saw over the weekend, this massive victory for the NDA. But again here, rationally and logically speaking, would you advise a re-entry in PSU stocks?
So I have always believed that PSU stocks have great value. Now, the incremental news flows is that the government in the second half of fiscal 25 would be signing or has already signed some 16 lakh crores worth of projects, and they would all come through the PSU, the government-owned company. So that is one news flow. And obviously, the entire revival in earnings for FY25 is built on the fact that government opens its purse strings, which was very, muted, so to speak, in the first half of fiscal 25. So that's the big news and big call on the PSUs per se. There is deep value, and obviously the DPAM new diktat paying 30% of profits as dividend, etc., are very good. And there is bound to be re-rating in the PSUs, not only in the banking space, but I think all monopolistic PSUs would have a case to be bought into. As far as the FI flows are concerned, look, I mean, there's nothing to believe that their selling could abate even now, because they have been selling across emerging markets. It's not one market preference over the other. It is basically money going to the US, and thanks to the change in regime in the US, you would see that massive outflows are happening from across emerging markets. It was so surprising to see Friday, you had a net negative figure from the FIs, in spite of very strong pullback and a short covering. So, yes, there is a bout of short covering, and markets don't correct in a one way, on the downside. But I think it's time to be very cautious. Low-hanging fruits of the last 4 years, when anything bought on a dip, you made money. I think that era is over. It is time to pick and choose very carefully.
So money making will be a little bit more difficult. Manish got that point, and you're sounding a little bit cautious. Still now, we have been talking about just the earnings downward revision. You're talking about the multiple as well could be not as high as it was earlier on the Nifty. People are giving it 22, 23 times. Or you said a more realistic number could be high teens. Got that point. The government spending was very, very bleak in the first 5 months of this fiscal. However, in the last couple of months, that's picked up as well. And hopefully that's what supports, a bit of a booster shot in terms of growth, in terms of earnings as well for the second half of the year. Given that sort of a backdrop, would you look at some of these infra themes, to play? Because some of them have corrected a decent amount from the peak.
Yeah, so basically, the disappointing part is that the private sector is not doing the capex. The heavy lifting in terms of spending has to come from the government. And from that point of view, I think infrastructure companies, etc., which have corrected 25, 30% could be looked into. But mind you, again, out here, when you take a call on, let's say, capital goods or infra players, and when you want to give earnings multiple to order books which have to be executed over the next 5-8 years, I mean, I don't think, that sort of a direct correlation exists between an order book, and that to long-dated order books, and PE multiple. I mean, to my mind, that's quite fallacious and driven more by sentiments rather than anything else. At best, you could, let's say, price in earnings growth on order books, which you have a visibility of the next 2, 3, 4 years. But nothing like an 8, 10-year order book, and you want to give a multiple to that. So again, out here, I would believe that the best sectors to invest in current times, given that there is a propensity for the currency to depreciate even from these levels, would be the export-oriented sectors. The IT pharmas of the world, banking in any case was very cheap. You could look in at PSUs and some of the platform companies, particularly the catering to the financial services side of things. I think those would be the best place. Still wary of the capital goods, power, infra, because they could be more sentimentally driven. But having said that, if you have hardcore numbers come through in terms of government spending, then obviously there could be a change in sentiments towards that. But I think valuations mostly are still quite prohibitive on the defense, railways, infra, capital goods, so to speak.
So valuations are still prohibitive on defense and many of these government-led infrastructure names. So you wouldn't look at buying now unless there's a major pickup in government spending in the second half, right? Just clarifying.
Exactly.
Okay, got it.
Yes, sir.
Okay, Manish, as we come to the fag end of the conversation, leave us with a few names though, bottom-up ideas where you think there is still growth with full disclosure and everything.
Prashant, I can't talk specific names, but suffice it to say, if you look at Q2 numbers, one of the areas where I think there could be a structural re-rating is this whole financialization of savings team, anything to do with tilt towards the equity market. Exchanges, depositories, wealth management platforms, online broking, distributors, there you could see a significant structural re-rating going to the next 2, 3, 4 years. You may find the near-term valuations expensive, but suffice it to say, the growth outlook on many of these platform companies catering to the capital markets, and because they are duopolies, oligopolies, you could have a strong structural re-rating on this whole thing, given that earnings visibility is quite sharp out here. This would be one of the preferred sectors where maybe the entire market is not looking into. And the other sectors where I think there could be a significant outperformance, and we are talking all relative numbers out here, could be your pharma, CDMO, your IT services coming out of a low cycle and spending is likely to pick up, given that the US regime change would mean corporate tax cuts and more spending on technology. Those would be helpful for the IT services and obviously banking. These would be the preferred areas.
All right. Manish, the first part that you said, right, capital market plays, I think we have the CAMS management joining us now. So I think if the management is hearing us, I'd be very pleased to hear that, your views on the subject. So capital market plays and CAMS, of course, is right up there. Manish, thank you very much for joining us. Great conversation as always. Thank you indeed.
Absolutely, as if that was on cue, right? Because we do have the CAMS management with us. And that's the real question. I mean, what is the growth runway ahead for businesses which are linked to the whole theme of financialization of savings? That's what we will discuss with CAMS right now. October, as we all know, saw record equity inflows coming into mutual funds again, almost 42,000 crores being poured into equity funds. And SIPs, they've crossed the 25,000 crore rupee mark per month for the first time ever. So what does this mean in terms of business for a company like CAMS? Anuj Kumar, Managing Director at CAMS, is with us. Mr. Kumar, great to have you on. Thanks for joining in. And your numbers are really telling the story, right? Because first half, you have grown at 30%. And I think in terms of margins, you're clocking EBITDA margins, you're clocking 45 to 46%. So those are stupendous numbers. Can you quantify, because this financialization of savings seems to be almost irreversible. That's the universal view. So as we look at CAMS, not just at the end of FY25, but say FY26 as well, what is the revenue trajectory? What is the margin trajectory? Because while the MF business grows, you're also talking about growing your non-MF business. So what will be the revenue pie and the margin profile?
Hi, good morning, and thanks for having me over on the show. Broadly, I think we are living in very, very exciting times. The retailization of the mutual funds market, just financial awareness across population segments in the country, I think is driving a movement, and we're fortunate to be a part of that. Like you said, if you see last quarter, we saw a revenue growth of almost 32%, which was an across-the-board revenue growth. It wasn't driven by a single segment. MF grew about 32.9, but the non-MF part also grew very close to 32%. On a profit level, we expanded EBITDA year on year by about 40-odd%. Now, whatever has happened in the months of October and November, I would say is perhaps a bit of a correction in the overall scheme of things. But the solid base effect of what's happened in the last 8 quarters, almost 2 years, is standing us in good stead. So I think for the second half, while we're not expecting revenue to be in the early 30s, mid to late 20s. And when I say that, I mean 26, 27, 28% is entirely on the cards. Similarly, an EBITDA growth of 40%, which we experienced in the last quarter, I think maybe a little more muted, maybe in the mid 30s, which is a 34, 35% growth. EBITDA margin, which has crept up by about 1.5% a year, is in the range of 46, 47%. I think it's safe to presume that if things hold at this level, we will hold margins at 46, 47%.
So just clarifying, just clarifying, so you are saying that revenue for FY25 will probably be towards the high 20s. So that, in some sense, that's a revision, because earlier I think you were guiding for 20% growth. Now it's going to be closer to 30%, with margins holding at around 47%.
Yes, yes. That's entirely possible if things hold at this level. And that is because, like I said, we have businesses firing on all cylinders across the board, not just in the MF book. So that looks entirely possible.
But EBITDA, the actual EBITDA growth, sir, that is, you're expecting that to come off a little bit.
Yes.
Between, you're saying 34 to 35%.
That's absolute EBITDA growth.
Absolute EBITDA, yes.
Yes. And a percentage EBITDA would be in the range of about 46% for the year.
Okay. This is largely going to be a function of, I mean, at the end of the day, the big overlay for you is how markets do, right? If we've had a couple of years of fantastic markets, flows have been very, very strong. So that is the big variable, right? I mean, as we head into 25 and look beyond FY25 itself.
Absolutely. Absolutely. I mean, just think of it this way, that as more and more retail investors kind of plug into the markets, businesses like KYC, KRA, and payments get a fill-up. And as more and more, the overall assets increase, that's a fill-up to our MF business. So that's how we participate in the markets, at a level of retail participation and at a level of net sales and AUM growth.
All right. Hi, Mr. Kumar. Good morning, and thanks a lot for joining in. This is Nigel on this side. Let's talk about a couple of important aspects. Now, flows continue despite the correction that we recently saw in the market. So your revenue base increases, but telescopic pricing, that comes into play, which could be a bit of a negative. Could you tell us, according to your analysis, which factor will outpace the other, in your opinion?
So think of the business this way, that the business is very efficient as it expands. It becomes efficient disproportionately as it expands. So as we get more revenue, I think our ability to take that marginal incremental revenue to the bottom line is very strong. That's how the business works. It far outweighs the telescopic pricing and any impact of the telescopic pricing. So we are always votaries of AUM expansion, whichever way it comes, whether it comes the retail way and we sell a lot and set up a lot of accounts, that's a good way. If it is market gains, again, it's a good way. But the telescopic pricing does not outweigh the impact of increased assets. And that's how the overall business works.
So just, Nigel, could you explain what is telescopic pricing for our viewers? What does it mean?
The way it works is that a buyer, as he buys more, buys incremental stuff cheaper. That's like any bulk purchase you have in any other product, whether it's IT or this, that when they buy more, the pricing goes down a little, and when they buy a little more. So as assets increase, their absolute pricing keeps coming down. That creates a very motivated buyer, because the buyer has money left on the table on his P&L to spend on other things. As far as we are concerned, because we are efficient at the margin, it makes sense for us to sell a little cheaper as assets expand.
Got it. All right. So asset expansion will take care of this perceived negative. Got that. Mr. Kumar, also, yields have been stable over the last few quarters. What's the outlook ahead on a steady state basis in the long term? How should it look like?
Our guidance has always been that because of the pricing, yields will deplete a little. They'll deplete about 2% a year. It's also a fact that some of the passives outgrowing the actives, as in when it happens, will also bring in slight compression in yields. I think it is safe to expect that a 2.5% compression in yields on an annual basis will be experienced. But like I said, all our growth and profit growth trajectory is predicated on this compression. It is despite the compression that we will expand the margin.
So finally, tell us what, again, I go back to that question of the revenue mix, not at the end of FY25, but a year down the line. Let's talk FY26. What will CAMS look like? How much from MF? How much from the non-MF businesses? If you could just break it up. I mean, how much will insurance contribute? You're doing the AIF business. There is insurance. And also the margin and the break-even timelines, because in the past you've stated that the non-MF business should move towards 25% blended margin. Are you on track with that?
Absolutely. Absolutely. So if you see three metrics, one, non-MF absolute revenue growth in percentage terms should be faster than MF. I think we have accomplished that for many quarters. Secondly, in terms of margin, the non-MF portfolio is now in its teens, in its late teens, which means getting to about 25, 26% should be a 6 to 8 quarter journey, but nothing longer than that. I think a lot of the new plays will start breaking even and will start contributing. Within non-MF, KRA and payments are two shining jewels, which are anyways at very strong platform kind of margin trajectory. About 5 or 6 quarters from now, let's say end of FY26, we expect MF to be about 84 to 85%, non-MF to have expanded to about 15 to 16%. That's a trajectory that we believe can be delivered.
All right, Mr. Kumar, we leave it there. Good luck. Thank you very much for taking out the time and being with us this morning here on CNBC-TV18. That is Mr. Anuj Kumar, Managing Director at CAMS. That is, of course, one of the foremost capital market plays, which markets have liked over the years, and have stocks, of course, done very, very well. We come back and we put the focus on the implications of the Maharashtra verdict, the election verdict on the real estate sector here in the state. We have Ghulam Zia of Knight Frank India and Bowman Rustam Irani of Keystone Realtors will be speaking with us on the opportunities and how this sort of landslide victory for the BJP in the state changes things. Stay with us. Welcome back. You're with us here on Bazaar. Well, you know, the market, the big story for the market, and the reason the market is celebrating, of course, is that the BJP-led Mahayuti alliance has secured a landslide victory in Maharashtra. And it's not just the alliance. BJP itself, of course, has come out on top somehow in the state. So that's a broad positive, sentiment positive that the market is trading on the back of. But specifically for the real estate space in Mumbai, in Maharashtra, what does this mean? Because after many years, you've got political stability for the next 5 years. Those are numbers, of course, in terms of what the final tally look like. Ghulam Zia, Senior Executive Director of Knight Frank India, and Bowman Irani, Chairman and Managing Director at Keystone Realtors, are joining us now to take some questions. Gentlemen, good morning. Great to have both of you here. Prashant this side. Bowman, if I can start with you, how does this change things up? Were things not moving fast enough, which will now move fast in terms of regulations, local taxation? What should the real estate industry expect? And of course, what's the ask really as well? Go on.
Prashant, first of all, I'd like to congratulate the government, the three-paya government, as it was called, for a landslide victory. And I can tell you this, that overall, the pace of growth that we have seen in the past should continue. We are looking forward to policy-driven, growth taking place, whether it's the MMR, whether it's all of Maharashtra. There's tremendous potential. I'm sure the BJP is going to be extremely happy that Maharashtra, which is one of the leading states in the country, is where they have such a solid base as of right now. I congratulate all three leaders, Mr. Devendra Fadnavis, Eknath Ji Shinde, and Ajit Dada Pawar, for a fantastic outcome that is there. We are looking forward to a very stable, I would like to say infrastructure-led, which was already the case, but stronger infrastructure-led growth taking place in our city, in MMR overall, at the same point in all of Maharashtra. And I'd like to say that on behalf of CREDAI and CREDAI MCHI, I pass on my heartiest congratulations to the government, and I look forward to interactions more often with them so that we are able to continue this supernormal growth that we are seeing in the real estate sector, to be able to drive the economy and to help affordable housing take more of a prominence in Maharashtra itself, and thereby lead the entire country to show the way going forward.
And I think, the point taken, Baman. Coming back, we'll just come back to you, Ghulam. Morning. What is your sense? Specifically, what does this win mean for the real estate space?
Well, what we have seen earlier, last couple of years, I would say, strong leadership was the requirement. And while we wanted to believe that the double engine government, the so-called double engine government, had to be fully in action, but that was something which is not showing so much of results because of, I won't say a weaker leadership, but an unclear mandate. But today, with a crystal clear mandate and no insecurity or looking back at what could happen to the government, etc., now we are expecting that way forward, we will see rock solid performance from the policymakers' side. And as Baman was talking about, infrastructure-led growth is going to be the key expectation. And of course, it has a direct impact on the health and performance of real estate, which, by the way, once again, as Baman was talking about, almost about a year and a half of a bumper show in Mumbai specifically, and even in Pune and other locations in Maharashtra. We've been watching fabulous growth in real estate. And now is the time to see even more growth in the real estate sector, led by a strong infrastructure performance. And also, because of double engine, we are expecting a lot of industrial focus to get back on Maharashtra, which for last a few years was not really the key factor.
All right. Good morning, gentlemen, and good to see you all in. Baman, talking about CREDAI, in fact, I bumped into a member president, if I'm not mistaken, down the road, and I asked him, I said, what do you think? He said it looked good and it's going to look even better from here on. So echoing the sentiment that you did say. Let's focus on the real estate part, though. You have a fair bit of exposure out there. What are the kind of policies, what the kind of boost do you expect to come in on this part of the business? Because it's clearly picking up steam after quite a while.
So, Nigel, thanks for that question. Actually, if you focus on the MMR area itself, I think the government's push towards infrastructure should continue. That's our first ask. Second is a clearer, policy that allows for better development to take place, especially if you look at Mumbai. The redevelopment space where we have a major play needs to be absolutely kind of put on, let's say, supercharge. And, as Ghulam said, Ghulam, just telling you, it's not a double engine, it's a triple engine Sarkar right now, with a full mandate of the people. And we look forward to a solid growth being there. Mumbai, as we all know, has got a great amount of slums. And it's already in the BJP's mandate that, they want to see a slum-free Mumbai city. So any drive towards that will continue to kind of boost the options of Mumbai's growth. One very important factor, which the government should focus on this time, is to improve the, use of, or rather coming of more offices in Mumbai. Without the growth of commercial development, Mumbai will not be able to sustain the growth. Mumbai was and will continue to be the financial capital of the country. And we hope towards this, the government has an absolutely clear mandate to make that continually grow. Places like BKC, places like Sibri, places like Lower Parel, and many more, mid-city development should take place so that there is a lot more of commercial development. sustainable, cheaper, and better commercial development with great infrastructure will drive the growth of Mumbai.
Baman, hi, great to have you on along with Ghulam. And when in your previous answer, when you were saying that there should be a big boost to affordable housing, I almost stopped, breathing. I thought, where? In Mumbai, where is affordable housing? But then you said Maharashtra. So yes, for Maharashtra as a state, maybe affordable housing will get a boost. But, the jokes aside, to talk about the city of Mumbai, because the sentiment is so strong now with this election win, what should we expect on pricing? What has been the average appreciation so far this calendar year? And going forward, what do you think the city is in for?
So, Surbhi, two things I'd like to state out here. A, it is possible to provide affordable housing. It does not have to be purchased affordable housing. One can look at, and the earlier, 2 or 3, or rather I would say 2 or 3 terms before, the government had come up with a fantastic scheme of rental housing. And that can be given a big boost. Around the world, you see cities developing on the back of good housing created by the government and then run by private enterprise on a rental housing model. I think that is very, very possible for the city of Mumbai. Second, I'd like to state that overall, with the infrastructure growth, with connectivity happening to Bhandup, Dombivli, Virar, Vasai, and even the Navi Mumbai belt, it is possible to get cheaper lands and give incentives to the developers and give incentive to the buyers as well. Why can't we have a stamp duty, which is a 2% stamp duty across the board for all residential real estate purchases, especially if it's your first purchase, and then give a further incentive to the lady member of the house if she's purchasing, because that gives more strength to the lady of the house who's basically the homemaker. And lastly, I'd like to say that there are certain taxes that are hugely impeding the cost of a home in Mumbai. I'd like to quote, what we've already submitted to the government in the past. We are paying anywhere between 28 and 32% of the value of the home. I'm not speaking of the cost. In terms of cost, it's much higher. In terms of value of the home that a home buyer pays, anywhere up to 32% is going indirectly into the coffers of the government. If we can talk of rationalizing these, we can talk of making a lot more affordable, homes a lot more affordable in Mumbai city.
Sure. I think those are some great ideas, and I'm sure a lot of this will be up for debate and discussion as the new dispensation gets underway. 30-second answer, Ghulam, over to you. Now, from an investor standpoint, and I'm talking about a call that runs into the next calendar year in 2025, would Mumbai feature in, say, your top 2 or 3 destinations to invest in from a real estate standpoint? And if yes, would it be residential, commercial, mix? What about Maharashtra and Mumbai? How does it fare in the national pecking order from an investor's perspective?
Well, from an investor's perspective, I would rather keep residential real estate aside, because I think your question, which was not answered by Berman, was on price rise. And we believe that the price is already going up, especially in mid to upper end, beyond any reasonability. And hence, any investment perspective for residential real estate is definitely out of question. Commercial, of course. Once again, while Mumbai has been showing good amount of new office buildings also coming up, Mumbai and Maharashtra would continue to be, and let's not forget Pune. Pune has always been on the commercial real estate map in a big way. So between Mumbai and Maharashtra, commercial real estate investment will continue to drive the investor sentiment, definitely not residential.
All right. The other thing, guys, is that we probably will also have BMC elections now.
Finally.
After 3-4 years, right?
Indeed.
And,
rooting for
the
Mumbai.
big stuff is good, but,
rooting for the roads.
maybe the roads.
Yeah, absolutely. Praying for
it. It's a bumpy ride out there, right? Right now, but maybe things will get better. Baman and Ghulam, thank you very much, if you're still there, for joining us with all that perspective. Thank you indeed for taking us through that. Major.
All right. Well, let's get to our next guest then. Let's talk about L&T Finance. The company has completed 30 years of operations. How's the business momentum in the near term? What's the broader outlook as well? To help us out with that, we have with us Mr. Sudipta Roy, the Managing Director and CEO of the company. Hi, Mr. Roy. Thanks a lot for joining in.
Thank
and
you,
congratulations to you as well as the entire team on this achievement.
Thank you.
Let's talk about business. I'm looking at your AUM. It's roughly around 93,000 crores odd. In the near term, what kind of AUM growth are you looking at? If you could break it up between segments, and say in the next 3 to 5 years, what kind of a target do you have on the AUM growth front?
Okay, see, as part of, we had initially announced in
Q4 FY22 about the Lakshya strategy for L&T Finance in consonance with overall L&T Group Lakshya strategy, where we had said that we would grow at about 25% CAGR, and we've been growing pretty well. In the last 3 years, we have increased our retail book from 45,000 crores out to about close to about 90,000 crores right now. One of the targets that we have taken on ourselves is to try to see if we can double the book in about the next 3.5 to 4 years' time, is what we would like to do. And, if you look at, we are one of those NBFCs which are, if you look at our asset profile,
yes,
we're almost actually 50% rural, 50% urban. And very few sort of NBFCs have this sort of balanced asset profile. And I do believe that, our growth will come equally from urban sectors as well as from rural.
Okay.
Though the urban might outpace rural over the next 3 to 4 years' time. So what I believe is that this urban-rural split might move to 60% urban, 40% rural. And, in rural, as you know, we are the third largest in microfinance. So that business will continue to grow, but probably that business will continue to grow at a little lesser clip than, whatever has been growing in the last 2 to 3 years.
Yes.
However, the urban businesses, especially home loans, loan against property, SME loans, maybe a little bit of consumer loans like personal loans, two-wheeler loans. We are one of the largest in the country in two-wheeler loans. Most of these urban consumption-driven businesses will continue to grow at a much faster pace. Overall, we are looking at about a 25% growth rate, more or less on a steady-state basis.
Got it. And since you have a fair bit of exposure to the rural as well as urban as of now, 50% apiece, give us your sense. There's a debate out there. Is there pain or there's no pain? Are you seeing stress in the system, particularly in the rural portfolio?
So I'll talk about the industry. Obviously, there is a little bit of a stress, especially in the MFI segment. There is leverage that has built, right? Though I would like to believe that we are one of those lenders who is least impacted by it because of our very prudent lending practices over the last 3 to 4 years, especially in the MFI segment. Yep. But however, there is stress. There are slippages and there are questions around asset quality. However, I do believe that on the back of the good monsoons that we have seen this year, and again, the election was a disruption. It was a 3 to 4 month disruption. And many of the social flows which were there actually went through a hiatus during that period. Majority of the social flows, etc., have started. The monsoon yield has been good. The Kharif crop has been good. We expect the Rabi crop to be very, very good as well. We had a rocking month in tractor disbursements in the month of October. Right. And in that tractor disbursement momentum continues in the month of November. And if you were to correlate tractor demand with sort of rural demand as well, I think the industry will probably see the worst of this crisis maybe, latter part of this quarter, early part of next quarter. Next year, I see normalcy coming back.
When you say crisis, you mean
MFI?
MFI.
And how would you, we spoke with a few other players last week. They said, well, fourth quarter should be the peak of MFI stress. Would you agree with that?
I would agree with that.
Jan to March?
I would agree with that because the Kharif crop arrivals have been good. We expect the Rabi arrivals to be good as well because the water reservoir levels are at record high after the good monsoons. So if on the back of both of this, the resumption of social flows, etc., I do believe that sometime in the middle of Q4 is when probably.
But would you agree that for NBFCs as a again, it's not L&T Finance per se.
Yeah.
RBI has come out. Regulation-wise, they've been coming down on various fronts, not just one line of business. Would you say growth? You said you'd like to double your loan book in the next 3 to 4 years.
3.5 to 4 years, yeah.
So there is slight moderation as compared to what you said earlier, which is 25% CAGR, right? Now you're probably between 15 and 20%.
Correct. See, the thing is that, some businesses will grow at a particular speed. Some businesses will probably go at a lesser speed. And again, you calibrate your growth according to the market conditions, right? So obviously, I would not say RBI has been singling out NBFCs. RBI has been generally, and the regulator has been generally sort of advocating moderation in certain asset class growth. And it is across the financial industry segment. And I think they are saying that, lend where you think the customer has the capacity to pay and do not lend beyond the customer's means. And also be transparent with the customer when you lend and make sure that no AG practices are resorted to while lending. So I guess it's a directional guidance to the entire system. Also, the RBI wants us to be very, very transparent with the customer in terms of pricing and wants to make pricing more reasonable. Because of all this, obviously, the industry will go through a little bit of adjustment phase before the new cadence sort of settles in. and that will lead to maybe, maybe the heady growth that you might, a couple of percentage points might be drawn from there. But I do believe that is good in long-term interest of the industry.
But does that mean in FY25, does that mean, say, 20% growth for you or 25%? Will that
It's very
continue?
difficult to pinpoint whether it's 20 to 25%. We have said that we will be directionally between 20 to 25%, and probably we'll land up somewhere between those numbers.
In that range, got that. On asset quality, so you're saying that the MFI situation will hopefully resolve itself by the fourth quarter. The other area of concern, which obviously the RBI flagged off this year, was personal loans and things like credit cards, etc., unsecured lending, basically.
Yes.
What are you picking up from the ground on that side of the portfolio? Is there any delinquency building up, any concern building up over there?
See, the prime personal loans portfolio continues to hold well, right? We only saw stress in the below 75,000 rupees ticket size, right? And if you look at the overall distribution of personal loans in the overall industry right now, probably the number will be somewhere between 13.5 to 14 lakhs of personal loans. The below 75,000 segment, I don't think is more than about 1 lakh or 1,25,000, 1.25 lakh crores odd. So it's a small portion of the portfolio that has stress, and large portion of that stress probably has, to a certain extent, flown, or it's stabilizing. In fact, if I look at the data, I think the entire personal loans industry as well as the consumer finance industry has shown some signs of stabilization post-September, October. So I do believe that that industry, that particular phase is probably over and the industry is moving towards stabilization.
3.2%, roughly 3.2% is where gross NPAs were for you at the last quarter, percentage. Is that the peak? Does it improve from here on? And again, I'm talking about an outlook for the next couple of quarters, not necessarily just this year end.
See, the fact is that we would like, our credit cost was roughly about 2.5%, whatever was our credit cost. So the fact is that, because the MFI, and we are a very large player in MFI, right? Yeah. So even if a 10% dilution in collection efficiencies leads to some flows, right? And because there was some flows in the early part of this year, which is between April, May, June, right? Some of those flows will keep on coming and moving into GS3 and NS3, respectively. So more or less, I do believe that the credit cost that we have at that particular level, we try to stabilize it at this particular level, but there might be some 10-15 basis points ups and downs for the next 1 or 2 quarters before it settles down again.
Very quickly, what about NIMs? What should it look like? It came off a little bit on a sequential basis.
Yes, the NIM came off a little bit primarily because, the asset quality, the asset mix actually changed, because we slowed down a little bit of MFI, which is generally a higher yield product. And, overall, your mortgage and LAP portion of our book has gone up. So because of the adjustment in the mix of the input products, the sort of the NIMs have moved a bit. But what we have guided is that we will try to keep our NIMs and fees between 10.5 to 11% is what we have guided.
All right, Mr. Roy, we congratulate you once again. This is a landmark milestone in that sense. And congratulations on the event tomorrow as well, right?
Thank you so much. Yeah, we are actually, we have actually retooled our sort of technology team, and we have one of the best teams. We would believe they're one of the best teams in the industry in terms of data science and artificial intelligence. So what we thought was that as part of our 30-year celebration, why not have a conference that looks at AI's applicability to BFSI, real-life use cases, and we have the conference tomorrow. We got very good response, and we hope to have a good outcome tomorrow.
Absolutely. Congratulations and good luck for that event as well. Hope to see you tomorrow.
Thank you so much.
Thank you. Well, that is L&T Finance Management with perspective on the business across different segments. We'll take a quick commercial break here. We're going to come back. Mitesh Thakkar will be with us. We focus back on the market, which, by the way, is up 370 points. So we're round about where we started in the morning at 9:15. So 24,278. Take that break. See you on the other side.
Welcome back. Well, the markets continue to hold with good gains. So 350 points is what we had at the start, and we're holding with those gains. So the bulls will be quite happy. Let's get Mitesh Thakkar back onto the show. Mitesh, it's a good start. First 1 hour goes to the bulls, and they'll be feeling good. What about trades? What do you have for us?
Good morning, Nigel. I think the setup is still positive. With this kind of a gap up, there's always a risk of an intraday decline, and I think that can still happen. But the good thing is that the daily, the 2 hourly, the 4 hourly charts have all turned up, which indicates that possibly, even if there's a decline or if there's an intraday dip, I think that will be bought into. So on the Nifty, I think, traders, if they get a level of around 24, 150, 180 zones, I think that's the level to enter with a 50, 70 point kind of a stop loss. And I think on the upside, let's look at 24,500 as the target area. And on the stock side, we have all buy calls. In fact, the long side is in direction to trade. So I have a buy on IPC Ipca Labs with the disclaimer that, that's a recommendation to our clients. And I also have some long call option positions, so there's vested interest. But Ipca Labs can be bought with a stop below day's low of 1595. Look for a target of around 1640 or thereabouts on the upside. And the second stock which I like is JK Cement, which I would recommend buying with a stop at about 4,200 for a target of around 4425.
On Reliance Industries, it's at its 20 DMA. It's seen a good bounce in the last 2 sessions. Where is that headed? Important for the Nifty?
Very important, Nigel. I think it's heading towards 1320, 1315 zones, which is about 20 points away from here. And there's, as you rightly said, a couple of averages coming in. And then possibly 1370. So I think the way traders should approach this is that take some profits to 1320, trail your stop losses. And once it starts getting past those 1320, 25 zones, look for a target of 1370.
Okay, all right, Mitesh. Thanks a lot for that. Well, we have got our eye on the equity markets for the time being. Manisha joins us. She's going to tell us what's going on in the commodity markets as well. Manisha, take it away.
Well, thank you so much for that. I want to take a look at the precious metal prices, where last week was a grand one. You saw gold and silver prices both gain quite strongly. Gold actually was up 5.5%. Making it the best weekly gain in last 2 years in that sense. The prices did gain from a low of almost 25.70 on the lower side, 25.40 by the way, and did see 2700 on the higher side. The Asian markets right now, though, are headed in for a bit of a profit taking on those kind of levels. So 1.5% of a decline, as you can see. But that is the range, 2536 to 2700, that we have seen in last 10 days come in for the gold prices. And with that, I also want to show you on what we've done in sense of gold prices in last 3 or 4 years. Well, it has been higher highs and higher lows, as you can see. Higher highs first, and we have seen prices continue to gain up. 1890 was a high in 2021, and then we've seen 1900, 2000, and almost 2800 in this year by now. The lows also have been on the higher side. Well, we saw 1700. It was only last year that we were trading at 1810, and 1992 has been the low for this year as well. Far away from where we are looking at in sense of highs and sense of gold there. So absolutely very strong real returns that you have seen gold give you in last many years, as you can see on your screen there. Well, it has to do with this very strong global central bank buying, where many of these banks have been adding gold to their forex reserves. It also has to do with the flare-up in the Russia-Ukraine war there. The markets are looking at safe haven buying continuing in case of gold there. The hedge funds have come back in a big way as well. It was last week that we saw net longs at a 15-week lows. But since the escalation and since the fact that we've seen markets continue to look at Trump impact on various taxes and infrastructure, etc., gold has seen buying come back because of that as well. And then this is going to be a 6th straight week in the month of October that you are looking at the global ETFs come into gold in a very strong way. The dollar index today is trading at a 1-year off as well, and that has been supportive. But the global ETFs now stand at around 3,244 tons. If you look at the overall AUMs, those have gained up by 33%. 5% of a jump up is what we saw in the month of October alone. For the Indian markets as well, the buying has been strong, whether it's about physical buying, ETF buying, and the futures and options also are hitting record highs there. For this year as well, even as the gold prices are trading at an all-time highs, you could be looking at imports anywhere between 700 to 900 tons. Well, going forward, all the Wall Street banks and brokerages do estimate that you're looking at higher prices from here on. So $2,900 to $3,000 an ounce is an expectation coming in from UBS, Goldman Sachs and Citi. This week is going to be quite important because you have so much of data coming in. Remember, it also is a truncated week because Thursday is Thanksgiving in US, Friday would shut early, so it really is a truncated week. But ahead of that, before that, you'll have the FOMC minutes come in, inflation, personal income spending, inflation data also from Australia and Eurozone, and then you have GDP numbers also coming in from India, Canada and various other countries. So a very data-heavy week, even as it's truncated, and the markets do believe that you could see some gains continuing in case of gold.
Okay, so gold will continue to sparkle in all probability. Got that, Manisha? Thank you very much. As we take the break, just keep your eye on the PSU part of the market. Stocks are ripping away. IFCI 11-12%. Look at some of the railway names like RailTel and RITES, 9-10%. There's such a huge amount of a sentiment boost coming back in. PSU, by the way, the PSU Bank Index is the biggest winner on the screen right now. And it's not just a State Bank of India. I mean, names like UCO, etc., they're all Central Bank of India. They're surging 5, 6, 7%. So railways and PSU banks are the greenest part of the PSU screen today. But there are other stocks like NBCC, etc. So big move on PSUs. With that, let's quickly take a break. And after this, it's our special segment, Indianomics. Today, Lata will be in conversation with Santanu Sengupta of Goldman Sachs to talk about the Indian economy outlook for 2025.
Hi, Shantanu. Hello.
Hello.
You can hear me?
Yeah, I can now.
Okay, there's one big man who may jack our happiness. Modi will speak ahead of the session start. He should know.
Okay. No problem.
Welcome back. The markets are zigzagging to daily news, but today on Indianomics, we're going to look ahead to 2025. India's central government is going to be much stronger and probably capable of more longer-term policies, while the US will also have a strong government that may be more mercantilist. That word literally means that you enrich yourself by protectionism and beggaring your neighbor. That's the literal meaning of mercantilism. Now, we're going to have a series of discussions on how the Indian economy will therefore pan out in 2025. And starting off the series of discussions is our interview with Shantanu Sengupta, the chief economist from Goldman Sachs India. Shantanu, good morning, and thank you very much indeed for joining us. Well, before I put our toes into 2025, we have the GDP number coming in on November 29th, end of this week. What's your sense of the second half? Your forecast for the current year, FY25, is a bit sober at only 6.4%. So you're not expecting much of a pickup in the second half?
Hi, look, no, we are not expecting much of a pickup in the second half. I mean, the usual suspects will be the government expenditure coming back. CapEx has been really low in the first half of the year. Some of that will come back. But we think we are in the middle of a cyclical slowdown, mainly due to overall fiscal tightening, which will continue into calendar 25, and the macroprudential tightening that you've seen from the RBI on consumer loans. And therefore, we are baking in a 6.4%. We have been there for a long time. We just shaved just a tad bit by 10 basis points in our outlook, but we have been at 6.5 for a very long time now, almost more than 3 months for the fiscal year 25.
This is the exact opposite of what the Reserve Bank has given us to understand, even in the latest bulletin. I mean, they have shaved off second quarter by a bit to probably 6.7 or thereabouts, if you look at their graph. But they're still sticking with a 7+ overall growth, which means for them the second half is better. For you, it looks like the second half is going to be 6.25 or 6.3 thereabouts, right?
That's right. So again, our point is that you will get the rebound from government capex, but consumption relatively remains slow. And it's difficult to imagine private capex pick up significantly over the next 2 quarters or maybe 3 quarters, given the amount of uncertainty that is there in the world today. So once Q1 of calendar year next passes and we have more clarity possibly on tariffs and US policy, I think that is when we can start baking in some kind of a capex recovery on the private side, and therefore we remain at a 6.4% year over year for fiscal year 25.
Okay. Well, now let me come to FY26. I won't take calendar 25. Since in India we all think fiscal. Your fiscal FY26 is 6.3. Now, don't you expect that we have several things going for us? Excellent monsoons and therefore possible consumption pickup. The fact that we could be beneficiaries of high tariffs on China and people migrating out of China, producers, as well strong government ability to take strong calls. Won't all this add up to something better in FY26?
So firstly, 6.3% growth is a very solid growth print in this world of uncertainty in our view. We think India's trend growth is around 6.5, maybe a tad higher. And therefore, this slowdown in our view is just a pullback towards trend. And there are 2 things that are broadly going on in the domestic economy. One, once you have the second half fiscal year 25 capex rebound, you're again going back to the fiscal consolidation path of the central government. We don't think there will be a departure in that. They have been unwavering in terms of that fiscal consolidation target, probably getting towards 4% in a couple of years' time, which means that you can expect a mid-4 kind of a target into fiscal year 26 for the fiscal deficit. That will remain, therefore, the fiscal will remain a drag. Secondly, there is no respite right now from the tightening of the macroprudential norms from the RBI. I mean, it happened a year back. You've seen the slowdown in credit growth. It's difficult to imagine that will turn around very quickly over the next quarter or so. We are baking in some recovery in the second half of the fiscal year 26 in terms of credit. And then if you look at the world, again, very difficult to imagine a net export boost from where you already are. I think our current account deficit is tracking around early 1% of GDP, right? It's anywhere between 1 to 1.2% of GDP. And it's difficult to, again, imagine getting a material net export boost. And therefore, from fiscal year 25 to fiscal year 26, we haven't really been able to see what will be boosting growth higher towards, let's say, a 7% or so. The caveat I'll just point out is that if there is a material improvement in the private capex cycle and it becomes more broad-based rather than being more concentrated, that will remain an upside risk to our growth view.
Okay. Let me first discuss the upside risk, and I will agree with your downside risks as well. But just playing devil's advocate, you know, the Chinese experience was when the demographic dividend hits, it is a huge inflection point. They did double digits. Many years between 1991 and 2007, that's several years of double-digit growth. You think we won't make it to 7 to 8%?
So 7 to 8 is a pretty high trend growth to think about. Our estimates from the supply side has been in the region of 6.5, maybe a push towards 7 if you do the right things on the supply side, especially on infrastructure development and so on. Now, because you're pointing out the demographic inflation point, I'll just say that, you know, in terms of consumption, we are looking at it in 3 layers. The upper end of the consumption pyramid is still doing pretty okay. You know, what we have been calling as
doing
affluent
very
people,
well.
That's still continuing to do very well. If you look at air traffic growth, if you look at the large hotels, they are still doing okay. It's the bottom end of the urban, which is dragging possibly from the retail credit slowdown. And on rural, we are feeling quite confident about a rural recovery after a very long time. After almost 2 or 3 years, we think that production is likely going to be okay. That is why we have a view that food inflation will come down, and that will boost real incomes in the rural segment. And you're already seeing a little bit of transfer payments happening at the state government level, not so much the central government, but the state government level. Multiple states are making transfer payments, especially towards women, which should boost rural incomes a little bit.
Okay, now I take your point. Now let me come to my downside fears. That's largely exactly the point you mentioned, since a whole host of states are into revenue expenditure because of transfer incomes. Do you expect that we could see some significant downside in the rate of growth of government capex? As you point out, private capex is not, gangbusters, it's just good. But government capex, which was gangbusters, may slow considerably because the states won't be able to put matching funds?
So again, on government capex, there are 2 things happening. One, the fiscal consolidation of the central government has meant that the nominal growth rate that you're having on capital expenditure is slowing down now. We think next year is going to be in line with nominal GDP growth rate. The year after, possibly you're going to grow in mid-single digits or somewhere around that if you're really going to 4% of GDP on the fiscal deficit. On the state capex, I would agree with you. If there's a shift that is happening, and we are estimating around 0.5% of GDP already for all states combined until now, shifting towards transfer payments. If you hold the fiscal deficit constant, then this money has to come from somewhere. And undoubtedly, we think that there'll be some reallocation happening from capex and maybe some reallocation happening from other current expenditure. Now, remember, for capex to continue, you still have a lot of savings. And this is a point we have been making for a long time. You have a lot of savings in India, which is all from insurance, pension funds, PF, and so on, which is anchoring the long end of the sovereign yield curve. And it's just about channelizing that money, which is seeking duration, into duration assets like infrastructure. So you need a quasi-sovereign entities to come out and issue to carry on the infrastructure boost in India if the central government is going to take a step back.
Okay. Yeah, I mean, there is the NAB FID, and then there is a lot of boost to the bond market if the index inclusion were to continue. So there is a possibility that surprises on the upside. Let me come to the external part and then get back to growth if time permits. The external front, you are expecting a weaker rupee, right? You're expecting it to go all the way to 86?
That's right, but I want to be careful here. We are calling it enduring external immunity. If you look at the rest of the world, the rest of the Asian currencies are depreciating a lot more in our forecast. Yes. INR is the clear outperformer. But even with that outperformance in the face of a stronger dollar, which is what we are expecting at least in the first half of next calendar year, we think that the rupee moves to 85, half 86 pretty soon over the next 3 to 6 months. But thereafter, it stays around 86 for the rest of the year. Of course, it is completely contingent on the dollar view. But we think that in this world of uncertainty, and I want to emphasize this, in this world of uncertainty, the immunity that India has is because of its services exports. It is less dependent on global shocks. Everybody in the world is today talking about manufacturing and tariff on manufacturing. But since you're doing so much on services exports, that is cushioning your current account balances. We think that is relatively more structural, and therefore INR is the outperformer for us in the Asian pack.
Okay. No, I never regretted appreciating rupee. I think there is a long narrative going on that you should have a strong currency. You shouldn't. It's good if we are going to depreciate. That will make us, ward off imports, especially Chinese imports, which you speak about in your piece. I just want to come back to the growth argument quickly. I'm not asking you to wear Timothy Moore's hat or Sunil Kaul's hat, but more broadly, do you think it's worth betting on the consumption sectors going forward than capex? Because that's where there seems to be a plateauing.
So I think we are calling out consumption, as I said, in 3 layers. We still remain pretty confident of the absolute top layer, which is, again, our consumption team has been calling out on affluent India. And the very bottom from the rural end, where, from the macro side, we are feeling pretty confident in terms of volume growth, given production, given lower inflation, given these transfer payments. It's the lower end of the urban which we think we will keep lagging. 1, because of lack of income growth. 2, because of the retail credit drag. I must point out one risk which our financial teams has been talking about of late, which is the MFI loan stress. Yeah. If that is going to be materially higher, that poses some risk to the rural recovery. But for rural, the production of the summer crop, that is the Kharif, will be super important to watch, because that is what can start boosting incomes, and therefore we remain pretty confident of the rural recovery.
Okay, totally out of time. Give me a 1-sentence answer. What is the upside risk to your estimates?
Our upside will mainly come from the capex boost from the private sector after the dust settles on what US policy is looking like in the first half of the year.
Yeah, one really hopes so, because last time Trump had a negative impact on global investment sentiment. One hopes this time he leaves behind a better legacy. Shantanu Sengupta, pleasure speaking with you, and thank you for kicking off our 2025 discussions with gusto. Look forward to a lot more economists joining us. For the moment, wrap up on Bazaar, but stay put. We have the Prime Minister coming to speak ahead of the winter session. Very important bills lined up, as Tim C. Jaipuria pointed out. We're going to have probably an tax arbitration mechanism in place, and that will be superb for ease of doing business in India. We are just waiting to hear the Prime Minister as he will address us on what to expect in the winter session. That's an extremely confident BJP, having swept the large and rich state of Maharashtra. So we must expect some very confident statements and a very good lineup of bills from the Prime Minister.
नमस्कार साथियों, शीतकालीन सत्र है और माहौल भी शीत ही रहेगा। दो 2024 का ये अंतिम कालखंड चल रहा है।